Hi, I'm Steven Van Metre. Welcome to your weekly economic update, where we take about 30 minutes every Friday to try to break down the economy, the markets, to see if we can actually make sense of them. Probably not going to accomplish too much of that, but we're going to try anyways, because the markets just don't make a whole lot of sense. Good news is good news, bad news is good news. In fact, all news is just buy more stocks. We're back, we're still in that mania where people just can't get enough stocks. So today, I want to openly admit I was completely wrong about this week's Nonfarm Payroll report. I had a really good chance at being right. In fact, I think it was like 100 or 220 or 240,000 jobs created, a headline number, fantastic number. Underneath that, there are about 100,000 of those jobs were created from the Bureau of Labor Statistics birth-death model, where they fictitiously, and they do admit to it, so it's not like I'm saying something that they're disagreeing with. They openly admit on their webpage that yes, this number is made up. It is an estimate of the number of newly self-employed people entering the economy, and because we don't know exactly, we make up this number every month. And so 100,000 jobs were made up, bringing us to say that over the last 6 months, most of the jobs created were from the birth-death model, unfortunately, and perhaps at a future point we'll look deeper into that. So today you're kind of reading about gold. I've done a deeper dive. There's going to be another piece, maybe next week after that, on more of the relationship with gold, and then we're going to get into maybe even a third piece on how I see it all playing out based on where we're at today. And the reason, so we did the rebalance. I want to get that out of the way. We did the rebalance. We primarily to shift up the duration. So when you go up in duration when in bonds, so you go from a shorter term bond to a longer term bond, when interest rates go down, the price of those longer term bonds goes up even more. And obviously we've been seeing the banking data showing banks are buying bonds. We need to get the portfolio switched over to that. And the secondary reason is not only do we need to get everyone back in sync, is we need to make sure there's cash available to take advantage of what opportunities are coming up in the gold space. So I need to free up some cash so we can use that position. And conveniently, the market is giving us an excuse to take in more risk in the bond market, which is great because we kind of already are seeing around the world interest rates are headed back to zero. And of course, the United States will not be far behind the rest of the world. We will too get to zero at some point. The content of this video is provided as educational information only and is not intended to provide investment and other advice. This material is not to be construed as a recommendation or solicitation to buy or sell any security, financial product, instrument, or participate in any particular trading strategy. This video was prepared by Steven Van Metre on personal capacity. The opinions expressed view are that of my own and do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial. So with that, in fact, we should just stay over there and continue on this path and take a look at what's going on. The M2 money supply on an annualized basis ticked higher, so more money is going into cash. This is not due to the Fed tightening. This is due to large investors selling stocks and raising cash. Meanwhile, as we know, retail investors are dumping cash to buy stocks because they believe this is the best time in their life to buy stocks. Unfortunately, they're completely wrong. The 6-month rate of change slid a little bit. The 3-month rate of change slid a little bit. Nothing to say the trend is going to significantly change. But for the moment, the money supply is rising. And when you are in a Fed tightening cycle and it starts to rise, that means investors are selling assets for cash. Commercial industrial lending slightly higher to 6.81% from 6.01% a year ago. Now, you remember we looked at, that would have been last Friday, the 3-month rate of change on commercial and industrial lending had contracted two weeks in a row. Well, this week they revised those negative numbers up a little bit, not much. So it did briefly touch a zero last week, and then this week the 3-month rate of change ticked a little bit higher, but still showing very weak growth, as if this blue line was way down here. So it's telling us there is not much going on in industrial or commercial industrial lending. And for all the reports we hear about how well the consumer is doing from their credit card basis and other revolving loans, They're charging only at a 6.38% on a year-over-year basis, so that's not very strong. Remember, as the consumer gets tapped out, the economy starts to go with it. The Feds continue to unwind their balance sheet by dropping at $13 billion last week, and that this will again slow and come to a stop here in a couple months. But what the Fed has planned, and I'm sure we will hear more about it, will be wonderful news for anyone holding long-term bonds. But as far as average Americans go, they still are not in great shape in terms of their bank accounts. Their deposit growth is only growing at 2.32%, so that is very, very weak long-term. And you want to see that number much higher going into recession, not real low. This is from Macro Bond and Nordea, and they said the S&P 500 is expecting a manufacturing boom. So here you see the S&P 500 6-month rate of change, and here is the ISM factory survey showing no rebound in sight, but stock investors are completely convinced that everybody else is wrong. Bonds are wrong, the factory data is wrong, the economic data is wrong. They think everything is wrong, and they're going to be proven right. And that's pretty hard to be the last man standing in Ring Around. Is it Ring Around the Rosie? The thing they play where the music stops and everyone's got to sit down. There's no chair. That's stock investors. So looking at global PMIs, this is from Per Valley or Teddy Vallee. If you want to go check him out on Twitter, this is his research firm, Per Valley Global. And he says, compared to the global factory data in black and U.S. 10-year Treasury yields in blue, that yield should be about 1.5%. Obviously, we could not agree more with that. That totally is in sync with my data. And as he might agree that if interest rates did hit 1.5%, the factory data is probably going to head lower. And it's important to note that the global factory sector is in contraction. It is below 50. When it's below 50, it denotes it's contracting. And again, you go back here and you see, wait a minute, what are U.S. investors seeing that the rest of the world isn't? Well, that's a good question. Class 8 truck orders are plunging again, down 69% from a year ago. I simply just say this isn't good. And you can see in 2016 we almost had a recession. This is worse. So it's clearly showing the transportation sector has problems. And for all the people that believe that crude oil prices are headed higher, you should probably close your eyes and not listen to this, what I'm about to say. But global crude inventories, this was just released Thursday, or Wednesday or Thursday. And anyways, year to date, crude oil inventories, global crude oil inventories are outpacing their 2017 and 2018 levels. And yet people are very bullish about oil. Pretty much sums it up right there. Can't get enough of it, but we've got too much of it. This is one of those things where you got to watch the price of this because the market is telling you something that isn't true. It's telling you that oil is a buy, and according to that, you might think it's a sell. All right, so let's go on to me being wrong, because it is fun. Here's a non-farm payroll report on a year-over-year basis. It's just right at this 1.5. It's been floating between 1.5 and 2%, as I mentioned previously. And here's construction spending headed lower. This non-farm payroll report is just literally 1 or 2 months away from having a move, starting to move lower, because there's no way if construction spending is going to contract that you're going to see an increase in payroll. One of the two things has to happen. Either construction spending needs to shoot higher, as you can see how well the relationship is between these two, or payroll growth needs to head lower, a lot lower, quicker. I imagine within the next 2 months, it'll be very clear which one of these is right. And when you're in a tightening cycle, construction spending is going to be the correct one, not the non-farm payroll. And in fact, if we were to go back and look at that commercial industrial lending chart, what is that telling us? It's telling us the same thing. With commercial industrial lending is flat or slightly contracting as it was previously 2 weeks ago, it's still telling you that lending growth is low. So whatever new loans are coming in, there's enough other companies that are not borrowing, they're paying down their loans. And that does not lead to more construction spending, does not lead to more jobs. All right, let's take a look at what's going on with the Federal Reserve, with the large commercial banks, assets and liabilities. And here we go. More reasons why we needed to rebalance. Not only did we get a big jump in Treasury bonds bought by banks last week, but this week they bought another last week they bought another 10 billion. This is always a week behind. So 2 weeks ago they bought a bunch of. Last week they bought 10 billion in U.S. Treasury bonds. They bought, looks like, 5 billion of mortgage-backed securities and another 6 billion of other type of bonds. So again, banks are buying bonds. Tells you financial conditions are tightening and they're concerned about it. And on to the NASDAQ McClellan Summation Index, which finally returned to positive territory. It only took the stock market making a new all-time high, which means it should be up here. It still tells us there's something wrong. It just doesn't tell us what it is. We just know there's something wrong in the markets because this thing should be way up here somewhere. And while there are concerns now that China is going to cut off U.S. farmers, even though they are still actually buying U.S. crops, agricultural commodities were down slightly, but we've seen warmer weather hitting all the way across the country now. When you have these solar minimums, and it's been more, in fact, I'll pull it up real quick. It has been more than 60 days, and we have not seen any sunspots. So it's very, very unusual. Even NASA says, hey, it's odd. You get swings between really hot and really cold. So here we have some heat wave, looks like, for summer. Some rain, you can see some, kind of in the middle here. It's some rain, but it's kind of finally, they're going to get average precipitation. But this heat is not good. Not after all that wet weather is not what the farmers want. So they're going to see above average temperatures. Wow. Wish I didn't have to see that. And then you can kind of see that finally some below average precipitation is kind of making its way through there, but it's too little too late. Farmers posting on Twitter over this past week have been showing that their corn is not growing anywhere where it was at this time last year. And on to our gold chart. I think we looked at this last week, but I thought I sent you the report on that last week, but I was wrong. I was a little ahead of myself. But anyways, we can see gold is kind of shooting a little ahead of inflation-adjusted U.S. Treasury yields, which are in red. And it kind of tells us the gold is just making too big of a move. And when you kind of factor what's happened, people have been buying gold on the notion the Fed is going to cut. Now, is the Fed likely to cut in July? It's going to be really hard for them to do that. The Bureau of Labor Statistics clearly could have made that number look a lot worse by saying there was no self-employed jobs created. And they could have put a low number in there that would have helped out. That would have given the Fed a reason to cut. It would have given President Trump a reason to threaten the Fed to cut. But it looks, the Fed goes by the headline number. So they're not going to see any problems with that. They're not going to see any problems with the stock market. They're going to see problems around the world, but they're going to say, hey, the U.S. labor market's doing okay. And then they're going to say, if it's not for the tariffs, things probably would be better. They're going to try to work this in. You're going to watch. They're going to try to work that in. Their meeting's not for a couple weeks, but you're going to see them try to work that in. So investors are now starting to deal with the fact that the Fed is unlikely to cut. In fact, expectations went from like an 80% chance of a cut to like 2.5%. That market is saying, okay, no more cut coming. The question is next week, as the big traders come back from their long weekend, what are they going to do? Now, I have been working on, and I'm going to try to pull it up here. So when I mentioned earlier, we rebalanced the portfolio to free up the cash, and I've been working on trying to come out with a way to enter the gold mining position and hedge it, and then slowly remove the hedge, maybe daily, weekly, just depending on what's going on. So that way we reduce downside risk. And so here you can see the junior gold miners trading, how they trade. And this was my hedge position using US dollars and gold miners. And to kind of show you how well it actually worked out, you can see it kind of really smoothed out a lot of these swings. And you might be wondering, well, why am I not showing you how it's allocated? Well, because I don't want anyone to run off and do this just yet. I know there are people that look at this and copy them, and I'm not ready for them to do that. But you can see I've kind of flattened this out, and I'm going to go back probably this weekend and run it with a 50% in short-term bonds. And you're probably like, well, why short-term bonds, mainly treasury bonds? Not because I'm in love with having more treasury bonds. They're extremely liquid. I mean, you can get out of these things anytime, anywhere, no matter what, because they're that liquid. So I'm going to maybe go look and say take half in short-term treasuries, and then, my split with gold and the US dollar. Again, not going to tell you exactly how that is going to look, even though I could show you. I'm not going to do that. And just kind of model it out. And then the idea being, once it's in there, it's much easier to remove something than it is to work around cash. So that's kind of what I'm thinking. We'll play around with it. I don't think we're at a point where we need to jump into gold just yet, because I think there's going to be one more dip. And let me clear some of this stuff off of my screen, and let's go on to the S&P 500, just sitting under new all-time highs based on bad economic data. If you look at German factory orders coming out, terrible. They're way down. I mean, the global economy is not in a good shape, but U.S. investors are never keen to that. They always get this wrong. They've gotten it wrong the last two times. They'll have it wrong this time, and they're going to look back, and one thing you're going to hear is professionals are going to say, look, you had 18 months to get out. We never had this amount of time in previous market tops. Never, never, never. So financial advisors, money managers, pension fund managers are all going to look back and be like, ooh, I had 18 months to do something. Instead, they put their clients in stocks rather than do the prudent thing. Even the Dow's kind of trying to break above its quadruple top, very unusual position to be in. We'll see if it holds going into next week. Volatility tried to make a little run today, not much, but this has just been hammered and compressed down to next to nothing. Let's take a look at 10-year treasury yields. We saw them back up today. That was not surprising given the payroll report. We saw 5-year treasury yields kind of jump back up, but as it came right up into this resistance area here. There's a lot of resistance right where I'm swinging my mouse back and forth here. Look at 10-year treasuries. There's a lot of resistance here because there's been buyers all right in here. Look at 30-year treasury yields. You want to know why I rebalance? I got it right up here. I got it right almost on that green line, and because it's heavy resistance. And then when you look at during the day, you can see this thing went down, 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 down most of the day. So it really is a signal that says, look, this run up here is going to get reversed. There's no question about it. We'll see how that all plays out. Looking at, let's see, interesting that oil and gas producers started the day lower and rallied back. Again, U.S. investors keep thinking oil is going to go straight up, but not when you have these ridiculously high global inventory levels. So at some point, we should start to see more builds coming. Maybe it'll be next week, the week after. Hard to say. Physical gold. All right. Well, you know what? We've been talking about bonds. Let's take a look at the bond chart. Again, this is a position we exited to move up the duration risk, and you can see it's just holding right here very, very well. Excuse me. 50-day moving average rising. Look at the long bond. This is where we got in, right above that purple line. And you can see the 50-day rising. I mean, this is all strong bullish patterns. And when bull markets break out, they go past their former all-time high and keep going. And at some point, this thing's going to shoot up and break through there and off to the races for sure. All right, next up, gold. Bouncing right off this 420 level. And you can see going back, it's just not, it's never been able, this is the last line in the sand. This move was way too quick. A lot of speculative moves here, a lot of retail investors chasing this. But from a moving average standpoint, it's got every reason to come back and reconfirm one of these weekly moving averages. You can see it kind of has a bias toward this 50-week moving average. It's just sitting way down here. So it's got some room to come back and visit that. and you can see it's right about the same spot as its 200-day moving average. So just the fact that it's not pushing through here, and it did drop today on the news that of the payroll report where the Fed's probably not going to ease, it kind of tells us that this is going to come back down. And we're still seeing investors fighting to keep this alive, but when you've got gaps, too many gaps sitting in here, unlikely that this thing stays elevated. I mean, it's just what you're seeing is buyers are getting a little less thrust, getting up here. They drove it up, went down, drove it up, down. So at some point they're going to give up if it doesn't break out, sell, and then prices come back down. Ag commodities are holding their 100-day moving average, doing okay there, bouncing off of resistance. When the USDA does redo their progress report and accurately state the condition of U.S. crops, this will go probably much higher, although people are saying they're going to try to delay that as long as possible. For what reasons, I couldn't tell you. What else do we have in here that's worth looking at? Trading volumes remain pretty low, not a surprise given holiday week. So let's see where we're at here. 20 minutes in, and I think we'll just, since we didn't really have anything yesterday, I think we'll just call this good for the week. And of course, we'll be back Monday, take a look and see how the hedge funds managers are positioned and see kind of what the big money as they come back from their holiday, how they decide to trade the market. I'm Steve Van Metre. Hope you have a great weekend. Bye now.